All right, let's talk about something that can feel, well, pretty overwhelming, but it's something you absolutely have to get your head around if you're a global entrepreneur: the US tax system. We're going to break it all down, simplify it, so you can make way smarter decisions and, let's be honest, save some serious money. So let's get right into it. So you're looking at doing business in the USA? I mean, of course you are. The opportunity is massive, right? But, and it's a big but, that tax system can feel like a giant roadblock. Getting this stuff right from the very beginning is absolutely critical for your success. And boom, here's a perfect example of that first big hurdle. You have to understand the US isn't just one tax system. It's more like 50 different ones, all layered on top of each other. Just look at this. A tale of two coasts, really. If you set up shop in California, you're looking at a pretty high state income tax, but move over to Texas, zero, nada. That one decision, where you're located, can totally change your company's financial picture. Okay, so yes, it's a maze, no doubt about it. But here's the thing about mazes. They have a solution. If you understand the rules of the game, you can find the most direct, most efficient path for your business. You can actually turn all this complexity into a competitive advantage. And let's be super clear about what's at stake here. This isn't just about ticking boxes and staying out of trouble. No, no. Getting this right, having a smart tax strategy from the get-go, that can literally save you millions of dollars. And maybe just as important, it'll save you from those administrative headaches that can absolutely crush a new business.
All right, so where do we even begin? Let's start by drawing a map of the territory. We're going to look at the four main types of taxes that pretty much every single business in the US is going to run into. Let's break them down.
Okay, first up, you've got your federal income tax. That's a big one, based on your profits. Then, like we just saw, you have state and sometimes even local taxes. Got employees? Well, then you're going to be dealing with payroll taxes. That's for stuff like Social Security. And last but not least, depending on what you're selling, you'll have sales tax. See, each one is a totally different piece of the puzzle you have to solve.
Think of federal tax as the foundation. Everybody's building on that same base. But the state taxes? That's where the real strategy comes in. For instance, you'll hear a lot about incorporating in a place like Delaware because it can have huge advantages. But here's the catch. If your team is actually working in a high-tax state like New York, a Delaware incorporation might not help you as much as you think. You've got to play the game on both the federal and the state level. Okay, so we've got the types of taxes down. The next massive decision on your plate is choosing your business structure. And trust me, this isn't just a boring legal detail. This choice directly shapes how much tax you're going to pay. It's the question every single founder wrestles with, right? Should I be an LLC, a C Corp, or maybe an S Corp? And honestly, there's no magic one-size-fits-all answer here. Each one has its own set of pros and cons, and it gets even more complicated for international founders. So let's look at the quick and dirty breakdown. An LLC, super flexible. The profits kind of pass through to your personal tax return. A C Corp is the classic choice. It's what most big investors and VCs are used to. But there's a potential sting: double taxation. The company gets taxed, and then you, the shareholder, get taxed again on dividends. Ouch. Then there's the S Corp, which is clever because it avoids that double tax hit. The problem, it has really strict ownership rules, which means it's often a no-go for non-US residents.
Okay, now let's get into the stuff that's specifically for you, the international entrepreneur. Because when you're operating across borders, a whole new layer of rules comes into play, and you really, really need to know what they are.
Probably the single most important concept you need to wrap your head around is something called a double taxation treaty. It sounds complicated, but it's basically a formal deal the US makes with other countries to stop you from facing a really, really expensive problem. Here's the bottom line. Without one of these treaties, you could earn $1 in the US, pay tax on it there, and then have to pay tax on that very same dollar back in your home country. No way! These agreements are designed to make sure that doesn't happen. They spell out exactly who gets to tax what, so you're not paying twice.
There are a couple of other really key rules to keep in mind. First, if you have a US company, it's taxed on its income from everywhere in the world, not just what it makes in the States. Second, and this one is huge, if your US company needs to pay a foreign partner or contractor, you might have to withhold, basically hold back, a chunk of that money and send it straight to the IRS. That's a super important detail you can't miss.
Okay, we've talked a lot about the what and the why. Now let's get practical. Let's talk about the how. How do you actually stay on the right side of the IRS and avoid all the drama? It really just comes down to a few key habits.
3 steps. They're simple, but they are absolutely non-negotiable. Number 1, file on time. Seriously, those deadlines aren't suggestions, and the penalties can pile up like crazy.
Number 2, keep amazing records. Invoices, receipts, payroll, everything. Good records are your best friend. And number 3, and this might be the most important of all, hire a specialist.
And this quote just hits the nail on the head. Look, the money you spend on a real expert, someone who lives and breathes this stuff, is almost always going to be less than the cost of making just one big mistake. And think about it. They're not just there to keep you out of trouble. A great specialist will find savings and opportunities you never even knew existed.
All right, so let's do a super quick recap. What are the big takeaways? 1, the U.S. is a 2-layer cake of taxes, federal and state. You have to plan for both. 2, how you structure your company, LLC, C Corp, whatever, is a massive tax decision, so don't take it lightly. And 3, if you're an international founder, those tax treaties and withholding rules are your Bible. You've got to know them.
And I've got one last little fact for you, and this one might be surprising. You don't even need to have a U.S. company to have a U.S. tax obligation. That's right, if you're earning enough money from customers in the U.S., that alone can trigger the need to file and pay taxes there, even if your business is based halfway around the world. Just knowing that can save you so much trouble later on.
So, when it all comes down to it, it's this. Your venture is ready. Your idea is solid. You're ready to take on the U.S. market. But the question is your tax strategy ready too? Is it as smart and as ambitious as the rest of your plan? Something to think about. Thanks for tuning in.